Okay, so hello and welcome to our second chapter 4 lecture video. So what we're going to talk about now are the steps in the closing process and actually do the journal entries. So with the closing process is going to start with the adjusted trial balance. So here we have our fast forward adjusted trial balance. We have a cash balance $43.50, accounts receivable $1,800, supplies $86.70, prepaid insurance $2,300, equipment of $26,000. Those are all of our debits. Accumulated depreciation equipment of $375, accounts payable $6,200, salaries payable $210, unearned consulting revenue of $27.50, and then our capital of $30,000. Those are all of our credits. We have our withdrawals debit of $200, consulting revenue credit $78.50, rental revenue credit $300, depreciation expense $375, salaries expense $1,610, insurance expense $100, rent expense $1,000, supplies expense $1,050, utilities $230, and those are all of our debits there. And so we add up all of our debits and we get $47,685, and we add up all of our credits $47,685, and then the to balance, and then we're good. So our first step will be to close our revenue accounts to income summary. Okay, it will be to close our revenue accounts to income summary. And how do we do that? We do that with the journal entry. So we have to think, I'm going to do a T account right over here. So with our consulting revenue. So see our consulting revenue. Now that, look in my adjusted trial balance and it says consulting revenue $7,850. And remember, with our T accounts, the credits are on the right, the debits are on the left. Okay? So that has a balance. This is telling me from the adjusted trial balance that the balance in consulting revenue is $78.50. And what I need to do with the closing process is I need to give consulting revenue a zero balance so that I can start collecting consulting revenue for the next accounting period. Okay, because these revenue and expense accounts are collecting revenues and expenses for a certain year, for a certain accounting period. So we have to reset the balance to zero so it can start collecting for the next year. Okay, so if I think about that in terms of debits, credits, it has a credit balance of $78.50. How do I make it so that it's zero? Well, I put a debit of $78.50. So I'm going to debit my consulting revenue for $78.50. And then I'm going to look at my rental revenue. That's the other thing I have. And then that says it's $300. And that's also a credit balance of $300 on the right side of the T account. How do I give rental revenue a zero balance? I debit it. $300 right there. Okay? So now we can think about our journal entry. So we know that we will debit consulting revenue and credit rental revenue. Now, we know about journal entries that your total debits has to equal your total credits. And right now, we have a debit to consulting revenue and a debit to rental revenue. So we have to credit something. And what do we credit? We credit income summary. So remember, income summary, as I mentioned in the first lecture video, is just a temporary area where we hold our revenues and expenses. Okay? It's a temporary area where we're going to hold our revenues and expenses. And then we are then going to move the balance in income summary to capital. Okay, so we're going to put it in income summary as an intermediate step and then move it from income summary to capital. It just makes it easier rather than going revenues and expenses straight to capital. Okay, it just is cleaner to do this intermediate step, and that's why we do it. Okay. So when we think about our journal entry, we're going to debit consulting revenue for $7,850. I will debit rental revenue for $300, and then I will credit income summary for the $78.50 plus the $300, or $8,100. 150. And then I have over here T accounts after close, but you can see I wrote the T accounts after close right up here. We have our consulting revenue. It's got a zero balance because it has a debit for $78.50 and a credit for $78.50. Rental revenue also has a zero balance. Okay, so it's zeroed out and the revenue is moved to income summary. So that's the first step. First step is to close out the credit balances in our revenue accounts to income summary. The second step is to close out our debit balances in our expense accounts, such as rent expense, depreciation, supplies, insurance, to income summary. Okay? So if you look over here, if you look at steps 1 and 2 again, it says close out the credit balances. What this is telling you, right? Remember, the normal balance for a revenue account is a credit. That's why it has a credit balance. The normal balance for an expense account, such as rent expense, is a debit. That's why it says close the debit balances. Okay? So we look over here, and again, we're working off our adjusted trial balance. We're working off our adjusted trial balance. And what we're going to do is we have to look at our adjusted trial balance, and here's all of our expense accounts. So we're going to zero out all these accounts, and we're going to move the balance for each one of these to income summary. So I'm just going to take one of those accounts. I'm not going to do all of them. Okay, so I'll take depreciation. I'll do that in terms of a T account. So I've got depreciation expense. This $375 right here in the adjusted trial balance, it's a debit balance, and you can see that because it's under the debit column. But also we know that the normal balance of an expense is a debit. So I put that on the left side of my T account right over there. Now the question is, how do I give depreciation expense a zero balance? What do I need to do to depreciation expense? I need to credit it. Because if I put $375 on the credit side, now $375 minus $375, the balance is zero. Okay? I will do that exact same thing for salaries, insurance, rent, supplies, and utilities. All these have debit balances, and I will credit each one of these accounts. Okay? And then I will move it to income summary. So let's look at the journal entry. So what I'm going to do is if I add the $375 for depreciation plus the $1,610 salaries plus the $100 insurance, $1,000 rent, $1,050 supplies, $230 utilities. If I add all those up, what I get is $4,365. That's my total expenses. Okay? And rather than doing a journal entry for depreciation to income summary, and then salaries to income summary, and then insurance to income summary, and rent to income summary, doing a journal entry for each one of those, right? I'm going to add up all of these, and I'm going to do the total here to income summary, and then I'm going to credit each one of these accounts. It's just easier, so I don't have to do multiple journal entries. I can do it all in one journal entry. The effect is the same, but it's just cleaner and easier to do it with one journal entry. So I add up all these. Okay, now the question becomes, do I debit income summary? Because I'm going to move it to income summary. Do I debit income summary or do I credit income summary? Well, we can think about that in terms of what do we have to do with our T account over here for depreciation expense. We have the $375 debit here, and then we said to zero out depreciation, I have to credit it. So all my expense accounts, depreciation, salaries, insurance, rent, supplies, utilities, will be credited, which means I need to debit income summary for the total. So I'll come over here and I will debit income summary for our total, $4,365. And then I'm going to credit depreciation, $375. I will credit salaries. I will credit insurance. $100. Rent expense for my $1,000. So I'm crediting depreciation $375, salaries $1,610, insurance $100, rent $1,000. Let's see, supplies, 1,050, and then utilities for 230. And I think I got them all. Yep, I got them all. Just want to make sure. So this is my journal entry, debit to income summary, 4,365, credit depreciation, 375, credit supplies, 1,610, credit insurance expense, 100. All these numbers again are coming from the adjusted trial balance. Credit to rent expense, 1,000, credit supplies expense, 1,050, and credit supplies, 230. Okay, so that's the second step. First step, revenue accounts. Second step, expense accounts. If you wanted to be a rebel and you want to do expenses first and revenue second, that's fine. If it feels good to break the rules, go ahead and do that. It doesn't make a difference whether you do revenues or expenses first. This is just the way I have it. But if you want to be crazy and do expenses first, go ahead. Okay? So the third step, though, you have to do expenses and revenues to income summary before you can do the third step, which is to close the balance, or what's left over in income summary has to be closed to owner's capital. Okay? So let's look on the next page, and let's do a T account here, because T accounts are fun. Do a T account over here for our income summary. Okay? So I've got my income summary right over here, and this is after I've done steps 1 and 2. So remember, I credited income summary in step 1 for 8,150, and then I just debited income summary in step 2 for 4,365. Okay, so that means the balance in income summary is a credit, because I can see my credits over here, 8150, greater than my debits. My balance in income summary is 3,785. That is my balance in income summary. Now, what does this balance represent? Well, it's really, what is the credit to income summary? That's my revenues. What is the debit to income summary? That's my expenses. So what did I do? Revenues minus expenses, 3,785 credit balance in income summary is net income. And like what we've talked about, even back in Chapter 1 lecture videos, we moved net income to owner's capital as we did in the statement of owner's equity. Remember that? Moved net income to owner's capital in the statement of owner's equity. And what I'm showing you in this chapter is simply how to do the journal entry to do that. Okay? Needs to do that as part of the close process. And again, let me just make sure that with the close process, this is done after the adjusting journal entries. So it's done at the end of the accounting period. So all these journal entries would be dated 12/31, assuming the end of the accounting period is the end of the calendar year, which has been our assumption. So let's go back to the T account. So if I want to give income summary a 0 balance, what do I need to do? Well, I've got this credit balance of 3,785. I need to debit it. Put a debit over there. 3,785 on the debit column, the debit side, or the left side of the income summary T account. And by doing that, now I have my equivalent, right? I've got 4,365 plus 3,785 equals 8,150. 8,150 minus 8,150 is now 0. Okay? So when we think about our journal entry, we are going to debit income summary for 3,785. And then what will I credit? C. Taylor Capital. And why is it C. Taylor Capital? We'll look at the adjusted trial balance. It says C. Taylor Capital right there. Credit of $30,000. Okay, so that's my capital account. That's the name of my capital account because it says it right there. I will credit capital for the amount here in my income summary. Now, do I always credit capital? No. I could debit capital. And when could I debit capital? Well, let's say this was $10,000. Expenses were $10,000 and revenue is $8,150. Now I have a loss. Now I'd have to credit income summary and debit capital. Okay? Thanks so much.